Welcome to the Opening Bell Report.
It is Wednesday, February 18th, 2026. And if you've been glued to your screens this morning, or really any time in the last month, you know exactly what the vibe is.
Oh, yeah.
It is absolute chaos in the markets right now.
Chaos is, putting it mildly, it's a full-blown frenzy.
Everyone I talk to, my friends, my colleagues, even my cab driver this morning, they're all on the same hunt.
The hunt for the next NVIDIA.
Exactly. Everyone feels like they missed the boat on the big guys 5 years ago, and now they want that next massive infrastructure play. You know, the stock that turns a modest vacation fund into early retirement.
And usually when you hear about these next big thing companies, it's all smoke and mirrors. It's like rumors on message boards.
Right.
But today we're looking at a company that claims to have actually pulled off the pivot of the decade.
It is a bold claim. But we aren't just guessing here. We've got a comprehensive financial analysis report in front of us, dated tomorrow, actually, February 19th, 2026.
So we're kind of time traveling.
Yeah, about 24 hours into the future. We're looking at the data hot off the press.
It gives us a bit of an edge.
So we are talking about Applied Digital, ticker symbol APLD. Now, I have to be honest with you, right off the bat, when I first looked at this, I just scratched my head.
It doesn't make sense on the surface.
Not at all. I looked at the basics, and on paper, this company has negative net income. They're burning cash. Yet the market values them at nearly $9 billion.
$9 billion.
And they are being celebrated as the fastest growing AI stock compared to their peers. It just doesn't add up.
It sounds like a complete paradox, doesn't it? I mean, usually you want to buy companies that make money, not burn it.
Exactly. So the mission today is to figure out why. Why is the market paying such a massive premium for this specific company right now? Is it genius, or is it, a bubble waiting to pop?
To understand that premium and to really get why they're arguably the fastest growing name in the sector, you can't just look at a snapshot of today.
You have to go back.
You have to understand the metamorphosis. Because if we go back just 2 years, nobody was calling Applied Digital an AI darling.
Right. I mean, if we rewind to 2024, the stock was trading under $5. It was essentially dead money.
They were a crypto hosting service. They built data centers for Bitcoin miners. And let's be real, by 2024, that was a brutal business to be in.
Oh, absolutely.
Margins were razor thin, competition was everywhere, and your revenue was tied to the volatility of Bitcoin. If Bitcoin sneezed, your stock caught a cold.
So they were stuck in a commodity trap.
Yeah.
Just fighting for scraps.
Exactly. But then leadership made a decision that, well, it likely saved the company. They looked at their assets, the massive power contracts, the land, the cooling systems.
All the stuff you need for crypto mining.
Right. And they realized those same assets were desperately needed by a different customer. Artificial intelligence.
The pivot.
The pivot. They shifted to high-performance computing, or HPC. They decided to become an AI landlord.
Okay, I want to pause on that term because it keeps popping up in this report. AI landlord. It sounds catchy, but what does that actually mean in practice?
Well, think of it this way. Companies like CoreWeave, or even the big hyperscalers like Microsoft or Amazon, they need to train massive AI models.
Okay.
They have the supercomputers, the NVIDIA H100s, or whatever the current generation is. But you can't just plug those into a wall socket at some office park.
Right, you'd melt the building.
You melt the building. You need industrial scale power, specific liquid cooling, and massive security. Fly Digital just says, we build the shell.
The building.
We secure the 100 megawatts of power, you bring your computers, pay us rent, and we keep the lights on.
Okay, so they provide the physical infrastructure. Now, 2025 was the year we heard a lot of promises about this. I remember headlines about a $16 billion backlog?
Yeah, a massive theoretical backlog.
But investors are cynical people. A backlog is just a spreadsheet until the check clears.
That is the skepticism they had to overcome. And that brings us to right now, fiscal Q2 2026. This report is so significant because it's the show me quarter. They had to prove the pivot wasn't just a slide deck.
So did they show us? What are the numbers saying?
They did. The headline number is startling. Year-over-year revenue growth of 250%.
Wait, say that again.
250%. They hit $126.6 million for the quarter.
That's violent growth. That's not normal corporate expansion. That's a rocket ship.
It's explosive.
Yeah.
And it's driven almost entirely by one facility coming online, Polaris Forge.
Ah, okay.
It's a massive 100-megawatt facility.
But
when they energized that, they went from theoretical backlog to actual cash register.
Yeah.
That's why they're claiming the title of the fastest growing AI stock. They are bringing capacity online while others are, still pouring concrete.
But revenue is vanity, right? I can sell dollar bills for 50 cents and show you massive revenue growth. The question is, does the business model actually work? Are they making money on operations?
That is the second, and arguably more important, milestone in this report. For the first time in this cycle, Applied Digital posted positive adjusted EBITDA of $20.2 million.
Okay, let's unpack EBITDA for a second. We hear this term thrown around constantly. Earnings before interest, taxes, depreciation, and amortization. Why do we care about that instead of just, net income?
That's a great question. In the data center game, EBITDA is your truth teller for operations.
How so?
When you build a massive facility, accounting rules say you have to depreciate that building over time. That shows up as a huge expense on paper, even though you aren't writing a check for it every month.
Right.
It drags your net income down, making it look like you're losing money even if you aren't.
So net income includes these ghost costs.
Exactly. Adjusted EBITDA strips that out. It asks a really simple question. Is the machine itself, the act of renting space, generating more cash than it costs to run?
And at $20.2 million, the answer is yes.
The answer is yes. It proves the unit economics are sound. They aren't losing money on every lease. They have a viable business model.
So the machine works. But this brings me to the part of the analysis that really confused me at first. When we look at the landscape, APLD isn't the only player.
Not at all.
You have Iris Energy ticker IRN. You have Core Scientific ticker THERRZ. And when I look at the valuations, Applied Digital is trading at a price-to-sales ratio of about 37 times.
Which is just nosebleed territory.
Right. Meanwhile, Iris Energy is trading around 20 times sales. And from what I can tell in this report, Iris Energy has a cleaner balance sheet and is actually profitable on a net basis. So why is the market paying almost double the premium for APLD? Are investors just blind?
No, they aren't blind. They are just prioritizing a different metric. This is the core conflict of the entire sector right now.
Okay.
It's the debate between speed versus efficiency.
Speed versus efficiency. Break that down for me.
The market right now is in a land grab. The hyperscalers are in an arms race. They don't care if the landlord has a pristine balance sheet or high margins. They care if the landlord has keys available today.
They need it now.
Right now. So let's look at the quarter-over-quarter growth. Not year-over-year, but just the last 3 months compared to the 3 months prior.
Okay, hit me with the comparison.
Core Scientific grew 3% quarter-over-quarter. They're stable, but slow.
Okay.
Iris Energy grew 28%, which is genuinely impressive, don't get me wrong.
That's very good.
But Applied Digital, they grew 110% quarter-over-quarter.
Wow. So they effectively doubled the size of the business in, 90 days?
In 90 days, exactly. They are the pure play on speed. They are bringing capacity online faster than anyone else. Investors are betting that in an AI arms race, the fastest runner gets the gold, even if they run a bit sloppy.
Run a bit sloppy. That implies a trade-off. You don't get that kind of speed without cutting corners or sacrificing something.
And that is the efficiency counterpoint. This is where the bears, the skeptics, start to sharpen their knives. Let's talk about margins.
Okay.
Iris Energy boasts gross margins of roughly 68%.
68%. That's
Yeah.
That's like software level margins. That's huge for infrastructure. Usually if you're dealing with concrete and electricity, you're happy with 30%.
It's incredible. And the reason is that Iris Energy is vertically integrated. They own their own power infrastructure. They control the whole stack.
Okay, that makes sense.
Now look at Applied Digital. Their gross margin is around 20.5%.
That is a massive gap. We're talking nearly a 50% difference in profitability per dollar earned.
It's huge because APLD is acting as a middleman. They are leasing the land, they are securing the power contracts from utility companies, and then renting it out.
So they have more costs built in.
Right. They don't own the underlying power generation in the same way.
Yeah.
So to justify their valuation, APLD relies entirely on volume. They need to be massive to make real money. Iris relies on efficiency.
That's a great distinction. APLD is the volume merchant. IRN is the boutique manufacturer.
Yes.
And APLD is betting that demand is so high, nobody cares about the margin squeeze yet. They just want the space.
Precisely. They are betting that volume cures all ills. But this leads to the risk. And the report uses a phrase that I found, honestly, a little chilling.
Burning furniture to heat the house?
Yeah. You never want to hear that about a company you own.
It implies desperation, or at least unsustainability. Let's look at the financial health check. We celebrated the positive EBITDA, but what about the actual bottom line? Net income.
It's still ugly. Applied Digital lost $31.2 million in net income last quarter.
Oof.
Now, Compare that to Iris Energy, which posted $384.6 million in net income. Now, fair warning, Iron had some one-time accounting benefits in there, but even without them, they're profitable. APLD is not.
And what about cash flow? Because you can survive accounting losses, but you can't survive running out of cash.
This is the burning furniture part. Operating cash flow measures the actual cash moving in and out of the business just to keep the lights on.
The real money.
The real money. Iris Energy generates positive 29% of its sales as cash. Applied Digital consumes negative 12% of its sales.
So for every dollar they bring in, they are spending $1.12 just to operate.
In a sense, yes. They are cash flow negative to fuel this hypergrowth. They're spending aggressively to build the next facility before the checks clear from the last one. It's a strategy that requires constant funding.
Which means they are funding this growth with debt.
A lot of debt. The balance sheet shows they have a solid cash pile, about $2.3 billion in the bank. That sounds great on the surface.
What?
But they have about $2.6 billion in debt.
That is high leverage.
It's very high leverage. And this highlights their sensitivity to the macro environment. If interest rates tick up, or if they have to refinance that debt later, their costs skyrocket.
And that eats into that already thin 20% margin we talked about.
Immediately. So it's a high-wire act. They are sprinting across a tightrope, carrying a heavy backpack of debt, betting they can reach the other side scale before the wind picks up.
That is a perfect visualization. If they make it, they're a giant. If they slip, the fall is long.
And remember, when you have that much debt, you don't have much room for error. One delay in construction, one regulatory hurdle, and the math gets scary very fast.
Let's shift gears to the chart. I know we have a lot of technical traders listening who don't really care about debt loads or margins. They care about price action.
Right, the tape.
We're recording this with the price sitting around $31.91. What is the chart telling us?
Well, if you zoom out, you see this massive vertical line, a rally from $10 to over $42 in just 6 months.
An incredible run.
And since hitting that peak, it has pulled back and just gone sideways. Technicians call this a bull flag consolidation.
A bull flag. I love these terms. Visualize that for the listener who isn't looking at a screen.
Imagine a flagpole going straight up. That's the rally.
Yeah.
Then imagine a rectangular flag flapping sideways at the top. That's the consolidation.
Okay.
Usually that's interpreted as a pause that refreshes. The stock ran too hot, investors took some profit, and now it's just exchanging hands at a new higher level.
So it's building energy for the next move.
Typically, yes. The report identifies a critical level to watch, $30. That is the psychological floor.
Why $30 specifically?
It's a nice round number, and it's where buyers have stepped in previously. It acts as a support shelf. If it breaks below 30 with volume, that bull flag is invalidated.
The pattern fails.
The pattern fails, the shelf breaks, and things could get ugly fast.
And on the upside?
Resistance is at $35. If they can get a daily close above 35, the technical target is a breakout to retest the highs around $45.
Speaking of $45, that seems to be the consensus target from analysts as well. A moderate buy rating with about 41% upside from here.
It is.
But there is a massive caveat in this data, something that suggests this won't be a smooth ride to 45.
The short interest.
It's sitting at around 18.5%. For those who aren't glued to market beta every day, explain why that number matters so much.
Anything approaching 20% is considered incredibly high. It means nearly 1 in 5 shares available for trading has been sold short.
So people are betting against it. Hard.
Very hard. These are people looking at that debt, looking at the negative cash flow and saying, this is unsustainable, this is going to zero.
But that creates a powder keg, doesn't it?
It absolutely does. It creates the setup for a short squeeze. If Applied Digital comes out tomorrow and announces another massive lease with a hyperscaler, the stock price jumps.
And the shorts get burned.
Suddenly, all those short sellers are underwater. To stop losing money, they have to buy the stock back to close their position. Their buying drives the price up further, forcing more shorts to buy. It's a feedback loop.
So you have a situation where the stock is primed to move violently. It's not going to just drift.
Exactly. The report calls APLD a high beta proxy. That's fancy talk for saying it's volatile. It swings 5 to 10% in a single week.
Wow.
This is not a stock for a set-it-forget-it portfolio. This is not for your grandmother's retirement fund. This is for aggressive growth seekers who can handle the stomach churn.
So let's try to summarize the thesis here. We have a company that successfully pivoted from crypto to AI. They have real revenue staggering 250% growth, actually.
Which is undeniable.
But the cost of that growth is burned cash, thin margins, and a mountain of debt.
That's in a nutshell. They went all in. while their competitors like Core Scientific or Iris Energy kept one foot in Bitcoin mining as a safety net.
Hedge.
Yeah, a hedge. Applied Digital burned the boats. They said, we are an AI infrastructure company, period.
It's the riskiest play, but potentially the highest reward because of that speed.
The bull case is simple. They grow into their valuation. They hit that forecasted $500 million annual run rate by the end of 2026. If they do that, the debt becomes manageable, the cash flow turns positive, and the stock could see $60. They become a legitimate giant.
And the bear case?
The bear case is that they stumble. They run out of cash before they hit that scale. If they have to issue more shares to raise money, they dilute the current shareholders.
Making everyone's slice of the pie smaller.
And the stock could crash back down to $15.
It really feels like a binary outcome. There isn't much middle ground here.
That's the nature of infrastructure plays in a boom cycle. You're either a genius or a cautionary tale.
Now, before we wrap up, I want to circle back to something we touched on earlier, the idea of being a middleman.
Right.
We talked about how that hurts their margins compared to someone like Iris Energy. But isn't there a bigger, almost existential risk there?
This is the provocative thought I want the listener to really chew on, and it's something the report alludes to. Right now, the market values speed. The hyperscalers, Amazon, Microsoft, CoreWeave, they need space now.
They're desperate.
They're willing to pay a premium to a landlord like Applied Digital because they're desperate to train their models. But these hyperscalers have deeper pockets than any company in history.
Right. They have essentially infinite money. They could buy small countries.
So what happens in 3 years? If you are a hyperscaler and you are paying a middleman who is taking a cut, eventually, don't you just decide to build your own facility?
You cut out the landlord. You become your own landlord.
Exactly. How long does the landlord advantage last before the tenants decide they'd rather be homeowners?
That's a great question.
Applied Digital is betting they can stay ahead of that curve by always having the next facility ready faster than the giants can build it themselves. They have to be the speedboat outpacing the ocean liner.
But that is a treadmill that never stops.
It never stops. If they stumble, even for a quarter, the giants might just step over them. And that is the risk of the middleman model in the long term.
That is a fascinating dynamic to watch. Are they a permanent pillar of the AI economy, or are they just a temporary bridge until the giants catch up?
That is the multi-billion-dollar question. And frankly, the answer will probably be decided by how well they execute Polaris Forge 2 later this year.
We will certainly be watching. Well, that brings us to the end of this deep dive into the high-stakes, high-debt world of AI infrastructure. We hope this cleared up why everyone is screaming about a company with negative net income.
And why speed is the only metric that seems to matter right now.
Just remember, the market trades on the future, not the present.
Absolutely.
And as always, this is an analysis of the data, not financial advice. If you are playing in this sandbox, the report suggests keeping tight stop losses around $28 seems to be the magic number to protect your downside.
Safety first. Don't be a hero.
Thanks for listening. We'll see you.
Don't forget to like, share, and subscribe for more.